Hi, my name is John, the Guaranteed Retirement Guy. Today, I'm going to show you exactly how to generate $100,000 per year in guaranteed income for the rest of your life. Okay, so how do we do this? Well, disclaimer here, I sell annuities and I focus on guaranteed contractual agreements. And really, as far as guarantee is, you really can't get something that's guaranteed unless there is a contract involved. So I'm going to show you how this works. I'm going to share my screen. And if you're looking for annuities, I'd love to help you. You go to my website, johnstevenson.com. You will see all of my annuity calculators, and you can find out for yourself exactly what they're paying, depending on what your situation is and exactly how much premium is needed to generate $100,000 a year for the rest of your life. So I'm going to show you, though, different scenarios where you may not have to use as much premium as you thought you might need to use. Okay, so I'm going to show you the income rider, which generally gives you the most income, and I'm also going to show you the SPIA and the DIA, and they generate the same amount of income, but they usually require a lot more premium. They're a little bit more expensive, so you use them for different things. All right, so I'm sharing my screen. This is someone from Michigan. They're 57 years old. They've got $500,000. Okay, maybe that's all you have to invest, and you still want $100,000 per year. Well, the only lever that you have that you can really change on here, I mean, you can't change the premium, but you can change when you take the income. Okay, and so obviously, the more you put in, the sooner you can take that $100,000 per year. Okay, so this is guaranteed, this is contractual, and this is for the rest of your life. So based off of $500,000, if you were to put it in at age 57 and you waited 5 years, okay, right now what I'm seeing is $4,400 per month. Okay, so we're like a little over halfway there, right? Because we need what, $8,200, $8,300 a month. So let me change this to annual. All right, so $53,000 a year. So what if I wait till 67? Maybe I'm going to work till 67. And I'm going to take Social Security at 67. I want to maximize my payout. Okay, now we're getting closer. $83,000, $82,000 if you want A-rated. Okay, now what if I want to wait till 70? Because I'm going to maximize my Social Security payout. I want to get an extra 24% on top of my full retirement amount. Then what? All right, look at that. We are there. We are $53 away. Close enough. Okay. $100,000 per year, Clear Spring. You got Nationwide right below them. Then you got Global Atlantic. You got American Equity. But we are there. Okay. If you wanna, just dump a little bit extra money in there, let's say you put $510,000. Okay, that'll probably get you over it. All right. Yep. So you could do Clear Spring, 50-year-old company, or you could do Nationwide, 100-year-old company, and both of them you're going to get $100,000 per year for the rest of your life. But what we had to do is we had to defer it for 13 years. You still got good income. I mean, you only had to spend $510,000. Okay, that's pretty good. I'm going to show you we'll look at some different numbers here. And this is for a single payout for a male. Okay, if it's joint, that changes the payout a little bit. Okay, so what if your spouse, let's say you're married and your wife is a female. She is 58. Okay, she's 58. So you're going to take income at 70 and she's 71. Okay, if you look at that, it doesn't generate as much. You're like 5,000 away. So you're going to probably have to add I don't know, let's just say $530,000. Okay, we're almost there. Well, let's just say 540. So, and I'm married. My wife is 4 years younger. Okay, we're going to have to put even more because she's younger. Okay, this is showing someone who's a year older. All right, we just barely hit it, $100,000. So, but now it's guaranteed for my life and my wife. Okay, so if I live till 90 and she lives till 100 or 95 or whatever, she continues to get that income. And that's really important when you're looking at these lifetime payouts because that balance will run out. It's designed to run out. You can see here with index growth. If there is index growth, then that balance will run out by the time you're 80, 81, 82. Okay, and the death benefit there, you see that lasts for as long as you live. That lasts for as long as there is an account balance there. So if you look at that, say, all right, well, that's good. If something happens to me or my wife, then they're going to, get whatever's left in that account. But I'm leveraging this for a high pension payout, right? And if I take this till I'm 95, it's a $2.6 million payout from $540,000 for me and my wife. Pretty good, okay? that's how you do it. The mechanism you have to do is you just have to wait longer. Okay, you got to let this is benefit base grows, because the benefit base grows from 629 to 1.4 million. Okay, and that's multiplied by 6.85% withdrawal rate, giving you $100,000 per year. That's pretty good. Now, I'm going to go back here and I'm going to change some things. We're just going to play around with this. So again, go to my calculators on my website. If you want to play with these numbers yourself, it'll be a lot easier for you. So we'll say I am 65. Okay. I'm married. My spouse, 65 as well. Okay. But now I've got $1 million. Okay, I want to have $1 million. Maybe I got $3 million. I want to put $1 million in here. This is not going to be enough, but we'll see what it will pay you for an immediate payout, because now we're not going to let it defer at all. We're going to retire next month. Okay, we want $100,000 a year. Now, if you have Social Security coming out, then that's something you could still maybe you got $40,000 a year in Social Security and you only need $60,000 a year from an annuity to reach that goal. Then that might be more doable. So we'll pull this out. Let's say 65, take immediate income. We're taking it next month. Okay. $1 million. All right. So 74,000. So if I've got 40,000 coming in from Social Security plus this, yeah, I'm well over. I'm like $114,000 a year for the rest of my life. Pretty good. But what if I only want I want 100,000 from the annuity? Okay. I've got my Social Security, I got my pension, but I still want an extra $100,000. Okay. Well then, here's the easiest way to do this. I'm just going to go and I'm going to reverse engineer this. And you can do this on my website, on my calculators as well. I'm going to say my desired annual income is $100,000. Make this easy. Okay. So here's the lowest premium I need nationwide, 1.344. That's what I need. Okay. That is the lowest premium that I can pay for $100,000 per year starting right now. Okay. And you can see the math is pretty easy. All right. Well, we know in 13.44 years, I'm going to get all my premium back, and everything after that is gravy. Okay. That's good to know. 13 and a half years roughly. So if I'm 65, what is that? 68 and that's 78 and a half. So 78 and a half, I've received all of my money back. That's simple. But I bought a lifetime income contract. That's the whole reason why I bought it. So you got Nationwide, you got Prudential, if they're your favorite, or Symetra. You got a lot of different options here, but some of them are more expensive. They don't generate as much income. I'd love to sell you this one. This one will make me 3 points more in commission. I would love to sell it to you, but they require a lot more premium, and they're a good company too. You just have to be aware when guys are trying to sell you things, sometimes they are motivated by higher commissions from a certain carrier that will pay them more, and they won't show you other options because they'd rather make more. Okay. In my opinion, you still have to see what's available to you so you can make the best decision for yourself. Nationwide's a good company. I mean, they're 100 years old. They've got some of the highest customer ratings in the industry. They're good. So, and all these other ones are good too. But it just so happens that they are the ones that allow you to get that same income with the least amount of premium. So why not? So we'll pull this up. All right. So worst case scenario, if there's no index growth, your money will be gone by the time you're 12 years from now. But the income, that's contractual. That's guaranteed. That's why you got it. And then they show you, here's what it'll look like with index growth. Your account balance will last to you're like 80, 81. But again, this is lifetime income. This is what this is about. This is why you buy it. This is the contractual amount. This is guaranteed. That is forever. Okay. If you live till 95, you're taking out $3.1 million. That's simple. So you can see the rider charges. Look at there. Here's the rider charges. And they're charging this account. But this account is also earning at the same time. So it's kind of a wash on those. And then, of course, it's being depleted by the actual income as well. So, but here's the thing. You just have to ask yourself, do you want to generate $100,000 a year in guaranteed income? And do you want to be truly guaranteed, truly passive? Then buy a contract, okay? And you don't have to buy it with one carrier. You can spread it out if you want. Put it in 3 carriers. You can go here and say, all right, well, I'm going to put, I don't know, put $500,000 in this one and $500,000 in this one and put $400,000 or $500,000 in this one, because obviously these require a little bit more, right? So if you do spread it out, you can do that. Nothing wrong with that. But it's going to cost you 1.444, because these ones here roughly will cost you an extra $100,000. If you see the difference here, a little bit more. But that's roughly the difference. You're paying a $1.45 million if you were to spread out among 3 carriers, but a lot of times that makes sense. People are like, they don't want to shove all their money into one. But I do have people that will do that if they're A+ rated and they're old. So you be the judge of that. But Nationwide's good, Prudential's good. I would be perfectly comfortable putting that entire amount into either one of them because they're good. Even though the state, you got state insurance, whichever state you are, will insure these up to a certain amount. They don't insure the income. So what you're basing off of is you're basing off of the strength of the carrier. And so that's why you got to choose a good carrier when you're looking at lifetime income. And if you got this size of premium going in, then you got to think about that as well. So either way, I can help you. I'd love to help you. If you are looking to purchase an annuity, there's a link below this video. It goes directly to my calendar, or you can go to my website, johnstevenson.com. Check out the rates for yourself. Okay, don't take my word for it. And then if you feel comfortable, book a call with me. Now, you'll notice if you go to the income rider, which is what we're looking at here, this typically would generate the highest income for the least amount of premium. It will show you some accelerated options. Some options will pay you a little bit more than what I'm showing you here, but they do it temporarily, okay, for maybe 5, 6, 7 years, and they reduce it pretty substantially, like another 35% for life. So a lot of times those will pop up there, so fair warning on that. But before I close out this video, I wanted to show you the SPIA and the DIA options because I did mention I was going to talk about that. So let me do that real quick for you. I'm going to, same 65-year-old, I just want to compare. So we already know we need 1.344 for an income rider, okay? Great company, but that's what we need to generate $100,000 a year in guaranteed income, okay? Now I'm going to go to the SPIA because a lot of, maybe you're in New York. If you're in New York, you have to have a SPIA. You have to have a SPIA. That you can't do an income rider, okay? But if you're in any other state, you can. So we'll go to the SPIA. And some people, they just want a SPIA because they're more comfortable with that. That's kind of what they grew up knowing, and that's fine too. So cash refund, just in case something happens to you, that your beneficiaries get the balance. It's the same for an income rider. The death benefit's right here. If you don't use it up, it goes to your beneficiaries, okay? All right, so we'll go back here and we'll say $1 million, joint life, right? Because that's what we were doing here. Yep, joint life. All right, so now with that, I'm going to say, let's see here. Actually, you know what? Let me go back. That's monthly income for $1 million. I'm going to reverse engineer this just like I did the other one, and I want $100,000 per year. Let's see if that's per year or per month. Hold on. All right, that was per month. All right, let me go back here and we'll say, let me do my calculations here for this. So $100,000 divided by 12, that's $83.33. $83.33. That's what I want per month. How much premium will I need in a SPIA to deliver that amount contractually to me? All right, New York Life. I need $1.480,000, and it'll start next month. Okay, guaranteed for the rest of my life, no questions asked. Great carrier. Okay, the difference, of course, is I have to spend more money. Okay, I have to spend, well, quite a bit more money. I'm spending like $36,000 more for the same income. So, and it's just because I wanted to go with New York Life. Now, you might ask, why would anyone ever do this? Well, they do it because they don't like fees. And even though their net income is the same from both, they just don't like the fact that income riders charge fees. But if all you care is about the net income, then it doesn't matter, in my opinion, and save your money. So, but you also might be in a position where you're like, well, I want this, but I also want it to go to someone else, like the income. If me and my wife both die before the end of 30 years, I want to make sure that income will continue to someone for at least so basically I want lifetime income or 30 years, whichever is greater. Okay, so then I can do a certain period, and let's see if this will even do it for 30 years. Let's see, 30 years. So if I want that, because you might want the income to go to a kid or whoever. All right, so single premium, 1.541, so even more. So it's just, there are certain things you can do with these. And some people aren't married, okay? And they're like, well, I want to generate $100,000 per year, but I'm not married, but I have a partner, okay? And I want them to continue to get the income for as long as possible. Then you'll do a single life. You still do a 30-year period certain because that's all you can do. And so if they live longer than 30 years, they're going to have to find somewhere else to get that income. So anyway, same $100,000 as a single payout or 30 years, whichever is higher. So look at that. Single payouts, of course, generally do not require as much premium. But still, 1.524 with Penn Mutual versus 1.544 with New York Life. So either way, if you're looking for cheaper. You don't want to, you don't want to spend another $130,000, $140,000 for the same income and still get refunded the balance if you don't use it up, your beneficiaries. I would still recommend an income rider. But some people just hate fees and they don't care. But in my opinion, you're still out 130, 140 grand. So, and to me, that's a fee, right? Yeah, you're not paying fees in it, but it's more expensive to buy the same income. Okay. So it's kind of buried in there, and that's how they do it. They charge you more. So, and they say there's no fees, but they're charging you more. So you look at the fees on the income rider, you might be paying the same amount of fees on the income rider. But you're not actually paying it. You're not taking extra money out of your bank or out of your IRA to do it. They're charging the fees from the account balance, not your income. Okay, so it's net to you. So you can see this account balance here in an income rider, it goes down because it's being depleted by this, and it's being credited by whatever interest earnings, and the rider charges are being debited from it. So all that's happening at the same time. But you'll see the rider charges stop when there's no more money to take it from, because it's not being taken from your income. So I guess really when it comes down to it, you're still spending like $130,000, $140,000 less, okay, to purchase $100,000 in guaranteed income. All right, that's my plug for that. I do try to keep these videos short, but once again, this video has gone longer than I wanted. I apologize for that, but I hope this is giving you some value. I hope that it has answered your questions. And if you want to purchase an annuity with me, I'd love to help you. There is a link at my website, johnstevenson.com. Check out the calculators. Reach out to me if you feel comfortable. I'd love to help you. Or you can book a call right below this video, and you can do that as well. So if you like the video, make sure you like, subscribe, share, comment below. I'm happy to help. No one likes being sold or pushed into a product they don't want, and you're not going to have that with me. When you book a call with me, I will be there to answer your questions. Of course, I'd love to help you buy an annuity, but I don't want to try to sell you into something either or make you feel pressured. So that's important too. So hope that helps. I appreciate you watching, and we'll see you next time.